think the sort of first thing that I think most people think about, or the first question when you're thinking about financial markets, is whether they're efficient or not, whether they incorporate all known information, if it's possible to do sort of significantly better than the market as a whole. And I'm not sure. Used to be absolutely received economic wisdom that financial markets were efficient. Now it's I think it's still the dominant academic view, but there's a big debate, and there are partisans on both sides. It's actually, to me, it's actually a fairly simple question. The notion that markets are efficient derives from an a priori theory, which is the same sort of theory about all markets. There are lots of incentives, people acting in their own interest. They have to do that. It's a very appealing kind of a priori theory, but the thing about theories is they're supposed to make predictions, and if some of the things they predict don't come true, the theory has to be disregarded. And there are many counterexamples to financial market efficiencies. Sort of on one level, there are things like companies that have two different classes of stock that are economically identical. So Royal Shell used to have Dutch shares, Dutch shares that traded in Holland, and UK shares traded in London, economically identical, but their prices would fluctuate and fairly dramatically. In '98, I forget which way, but one of the share classes was at a 20% discount to the other, and that persisted for several years. So you have economically identical things trading at different prices. You have closed-end funds, which are vehicles that own a set of other securities, trade as a security, listed on the stock exchange, but what they do is own other securities. And whether they trade to a discount, whether the security in the closed-end fund trades at a discount or a premium to the stuff they own, fluctuates meaningfully in a way that's sort of difficult to recognize, with the idea that the security should be reflecting economic value. You have what are called stubs, where one public company owns a significant stake in another public company, and in instances where the one 3Com owned Palm, and the value of its Palm stake greatly exceeded the total value of the market capitalization of 3Com, and that persisted for a number of years. In general, less volatile stocks have done better over time than more volatile stocks, which is somewhat inconsistent with the notion of efficient markets. Lastly, there are a meaningful number of individuals and institutions whose sort of performance whose performance in portfolios is really inconsistent with the markets being efficient. It can't really be explained away by some of them can, but by luck or by inside information or by something. So while there's sort of a big academic debate, and then lastly, there are things like the internet bubble, more recently the housing bubble, or not usually called this, but the lending bubble, or the subprime mess, or so forth. Lots and lots of security loans, securities that people bought at par that were worth about somewhere between 0 and 15 or 20 cents, and now trade there. So I don't believe that markets are efficient, and it doesn't really seem like it should be an open question. So the people that believe it have to die, and then nobody will believe it anymore. Not very many of them change their mind, though they come up with more convoluted explanations. Clever, convoluted explanations for the counterfactual, for the things that happen in reality that the theory doesn't predict. So markets aren't that efficient. On the other hand, sort of doing better than the markets is a non-trivial exercise, and it's not as easy as it might appear, or as some people think it's impossible, other people think it's really easy. It's actually not impossible, but hard, and there are a number of challenges. First, for individuals, I think the primary challenge is if an individual sticks to sort of areas where they might have an informational advantage, or at least don't have an informational disadvantage, they won't own a diversified portfolio of securities, because their informational advantage will be narrow. They also have sort of limited access to the gamut of products and so forth, and restricted assets and restricted access and restricted offerings. So that's a challenge for individuals. Institutions or sort of professional investors, all spend a lot of money on information, and which requires infrastructure and resources and so forth. But the very sort of nature of being an institution constrains almost everybody, whether it's in our case, all our investors have 30-day liquidity. In mutual funds, it's daily liquidity, but their investors tend not to be as wide awake. But that's a constraint on us, is that except for the principals, maybe their families, maybe not, all our money can disappear in 30 days. So we have to be cognizant of that. We have clients that have sort of a set of expectations, which you also have to, if not be cognizant about, sort of deal with. And then there are kind of universal sort of psychological challenges, biases in people's thinking, and a number of things that are just sort of difficult for human beings to process and make intelligent decisions, and the kinds of things that have a serious mix of randomness and skill. That's sort of the hardest thing for human beings to process, is something that's kind of an unknown mix randomness and skill. People, we can understand something that's fully random and work out the statistics and be comfortable with that. To some degree, things that are sort of completely cut and dry, fully determinative. We like that too, but stuff that's mixed is very, very hard. I mean, quantum mechanics makes sense to no human being, in my view, and in those areas, people people are inclined to do sort of strange things. I mean, one thing. I play a fair amount of I play a little bit of poker, and I'm very interested in the game. And it's a little like the markets and other things, in that there's an element of randomness and an element of skill. One thing that's I find interesting, typically, if you play poker in a card room or a casino, I would say 9 times out of 10, somebody sitting at the table will tell you that they're not trying. It almost always happens. They'll say, I usually play for more money, and it's hard to concentrate, or I'm just screwing around. Sort of why do they do that? Why do they not? They could just be screwing around, but why do they tell you? And it's kind of my pet theory that they would rather they're setting up in advance to lose. They would rather lose because they're sort of screwing around than that's easier for them to sort of deal with than to they could put out their best game and they would do better, but they might lose anyway, given its sort of randomness, and it is that's that's the thing about really good poker players versus less good poker players. Really good poker players play close to their best all the time, and they're not really bothered when they lose. And I think that's that's true in markets too, and all sorts of decisions. What people are inclined to do, or are very interested in doing, is setting up, posturing for credit and blame in advance, and sort of having a pre-made excuse if things don't go right. They're interested to some degree, at least, in having an excuse if things don't go right, than in sort of maximizing the chance that things go right, because even maximizing the chance that things go right, you can't get it to be 100%. There's an element of randomness. Bad things can happen. So it's really, really hard to just focus on getting things right and not winning the argument, setting yourself up before the fact so that you can win an argument after the fact that you didn't, you just got unlucky. People are very inclined to see things as determinative, to sort of to attribute, and that not just in markets, but in the psychology literature, to believe if you're wired to believe if something if A happened before B, A caused B. B has to be caused by something, and A happened first before it. So that's what. So they assign causality. They're also inclined to focus on sort of recency, sort of things they see, even even if you know they are irrelevant. For example, in the psychology literature, famous example is famous kind of test question is a tester will give the person taking the test the name of two cities that they've never heard of and the distance that they're apart. So two random cities, XYZ and ABC, are 4,200 miles apart. And then they'll give them two other cities that they've never heard of and ask them how far apart they think they are. And people anchor to the information they were given, even though there's kind of no causality or no sort of reason why it should make any difference. So if the reference cities, the first cities, are 4,200 miles apart, the answers for the next two will center around 4,200 miles. And if the reference cities were 2,500 miles apart, they'll center about that. It is. I think it's useful to sort of know all the hardwiring biases and that people have, and to try and debias your thinking, but it's not easy, and in lots of cases it's not actually people's objectives. If any of you watch Mad Money on CNBC, Jim Cramer, any Cramerites? Nobody? Well, he starts his show. Some people want to make friends. I just want to make money. And if you watch the show and you see Kramer, it's pretty believable. I think it's true. Almost everybody in sort of financial markets is capable of saying that. I don't want to make friends. I just want to make money. But for most of them, it's not true. They have all sorts of things that they want to do other than make money. They have office politics. They have any number of other motivations, and that psychology is really hard and somewhat applicable to not just markets but other things. So markets aren't efficient, but it's not that easy to beat them. So what do we try to do? And I kind of would highlight what I view as three sorts of principles. The first, the investment world, I believe, divides between coupon clippers. Bonds historically came with coupons. Actual sort of coupons like the thing you bring to the grocery store, and get 25 cents off a can of coffee. So we have this security, and a 10-year bond would have 20 coupons attached to them, each with a date on them. And when the date came, you would cut the coupon off and go to the bank and get your interest payment. So that was called coupon clipping. Basically, something that coupons are things that you redeem for a stream of money. And in my view, the world divides between coupon clippers, sort of people that are interested in cash flow and taking in cash flow, and what I would call security resellers, people that own things that they intend to sell to somebody in the future at a higher price. And there are successful coupon clippers and there are successful securities resellers, and they tend to make their money off of sort of the off of the unsuccessful people in the other class. We try to be, I think sort of investing is about clipping coupons, about getting cash flow and getting and controlling cash flow. But there are good resellers, and I think reselling is an element of things like venture capital. The best venture capitalists don't just have great ideas or whatever, but they take an idea, they advance it a little bit, and then they sex it up and promote it, and have a good sense for what the public will buy, and they get a nice valuation from the public. And I think that's at least as much a distinguishing feature between good venture capitalists among each other than the quality of their ideas. There are sort of Kramer again. Kramer was a good security reseller. Had sort of a really good, spent a lot of time and effort, kind of figuring out what is it that people will want to buy next week, and that's what I'll buy today. Not because I'll derive income off of it, but because it's what people are going to want next week, and I'll be able to sell it higher. And that's some art, some science, and there are people that are very, very good at it. But we try to clip coupons. As does it's a Warren Buffettism. He says all investing is about coupon clipping, and the difference between equities and bonds are that bonds come with a coupon that's known, and equities have earnings in the future that you don't know. You also don't know that they'll give them to the equity owners and not to management, or they won't squander them in the future. But to Buffett, it is sort of the same thing. It's clipping coupons, and he describes his job as figuring out what the coupon is in an equity, and if it's high enough, he likes it. So the first sort of principle to me is clipping coupons. The second is that risk is primarily about what is the worst thing that can happen. In typical sort of Wall Street risk management, a lot of focus is on what is the range of moderately probable outcomes. So people talk about VAR, value at risk, and lots of people try and build VAR systems, and what they are trying to determine is how wide is the band of outcomes, how wide is the band of stuff that has a 95% probability or a 98% probability, usually 95 or 98, but not 99.9. And if I have a 98% chance of not losing $1, that works in the VAR screen, and the VAR and it won't tell you, won't distinguish between whether the 2% chance is of losing $10 or losing $100. And to me, that's a fundamentally wrong approach, and it's actually done because it's the sort of thing that statisticians are good at, and to some degree, it's harder to imagine the worst thing than to statistically sort of figure out the middle band. And there's a famous saying, if you're good with a hammer, everything looks like a nail. And that's sort of what that's like. But the really important thing is what's the worst thing that can happen. And the last sort of principle, which is actually most at odds with sort of the academic community and even sort of the general perception, and that is that you don't get paid for taking risk, you get paid for eliminating risk. I actually believe in the history of the planet, there are very, very few instances of people getting paid for taking risk. They get paid for eliminating it. As an example, if you think about a tightrope walker in the circus, there's a conception that he gets paid because it's a risky job. He might fall, he might fall down, kill himself. I think that conception is completely wrong. The lifetime earnings of a tight wire walker who falls down and kills himself aren't very good. And in fact, what he's getting paid for is that he practiced a whole lot when he was a little kid on a wire that if he fell off of, he wasn't going to get hurt. And that he's really getting paid for eliminating the risk of falling off via practice as opposed to taking it. You think about drug development, pharmaceutical companies, and people will say, well, discovering compounds that are effective drugs is an uncertain, risky business, and that's so pharmaceutical companies are able to make, sort of get paid for taking that risk. And I don't think so. I think they get paid for applying intelligence and not testing not for the compounds they test, but for the ones that they've eliminated testing for, because they know, because they understand the chemistry or a disease process and have some idea what sort of compounds are more likely to work than others. When I don't know if he remembers this, but when I last sort of explained this to Professor Schiller, he said, "Well, what about insurance companies?" And I said, "Proves my point. The sort of exact case. An individual, has risk of certain bad things happening. If the insurance company has risk, it's because they've made a mistake. If they're sort of doing their job right, they're actually diversifying away all the risk and relying on the law of large numbers. So a casino, does not have a risk that the law of large numbers will be repealed and a roulette table will be a long-term losing proposition, or a craps table will be a long-term losing proposition. They have risk that their overhead won't cover it, or that they won't have. Their risk is that a steady stream of people won't come and be making a steady stream of bets at which each of them has a slightly negative expectation. So we really want to think, whenever we look at anything, what kind of coupons can we extract? What's the worst possible thing that can happen, and how can we eliminate that?